I am Tara Jayalakshmi, Assistant Professor of Commerce, First Grade College, HSR Layout. Welcome to the subject Corporate Environment. The main topic is Capital of a Company. The subtopic is Share Capital, which we are going to deal in this session. Firstly, let us understand what do you mean by shares. Before I explain you what is share, we'll understand the capital, the meaning of capital. Capital is nothing but the amount which you invest in a business is capital. The amount which you invest in a business is called capital. If this amount is invested by a single person, then there is a single owner. If the amount which is invested in the company are in large number or it is shared by large number of people, then it is called as shares, because it is the investment is shared by a number of people, and each share is called as a unit. So this becomes, and combining all, it becomes share capital. So when a capital is shared, then we call it as a share capital. So share capital of a company is divided into a number of units of a fixed amount. So these units are called as shares. When share capital is divided into units and this unit is purchased by a investor by investing their money into a company, and this unit is called as share. Each unit is called as shares. So this term share is defined in the section 2 subsection 46 of the Companies Act 1956 as share means a share capital of a company, and it includes stock except where a distinction between stock and share is expressed or implied. Share is nothing but a share capital of a company. According to Justice Re Pauline 1935, he says a share is a sum of money, but it is the interest measured in sum of money. So it is the interest you put in the company and it is measured in terms of money. If I am investing 10,000 in Reliance company, so that is the share value that I am holding in that company, and it is measured in terms of money and in units. So how many shares I am purchasing in that company? If it is one share is equal to, if the share is one share is equal to 1000, then I hold a 10 share in Reliance company if I am investing 10,000. So a share is not a sum of money, but it is the interest measured in a sum of money and made up of various rights contained in the contract. And when you invest your amount in the company, you also hold a right. What is the right that you hold is you become the owner to the extent of the share you hold in the company. If you have more number of shares, more number of value, then you become the owner of the company, or to the extent of the share you hold, to that extent you become the owner of the company. So it is made up of various rights contained in the contract, including the rights to a sum of money of a more or less amount. Share capital. So share capital, the term capital and share capital have been held to be synonymous. Synonymous means interchangeably they are used. There are two kinds of share capital. They are one preference share capital, another one is equity share capital. Let us know what is equity share capital. The term equity means equal. When you have equity shares, when you invest in equity shares or a company is offering equity share, that means you are treated equally. To the extent of the shares you hold, you are treated equally. Equity shares are not preference shares. Equity shares are the real owner of the company because they are enjoying the profits. Equity share are also called as ordinary shares. Equity share are the real owner of the company. The investor of the equity share have the right to vote and participate in the management, and they have right to claim the assets of the company. The value of equity shares is expressed in various terms like par value, face value, book value, issue price, market price, intrinsic value, and so on. The advantages of equity share are, it is we can understand the advantages of equity share in two point of view. One is from the investor point of view, another one is company's point of view. In the investor's point of view, see, in investor's point of view, if you are investing in equity shares, then the whatever the profit you are with the when the company earns, you are getting a share. So you are getting a capital profit. Next, interest in company's activities. You can participate in the management, and you, as you are the real owner of the company, if your shareholding is more, then you also have the right or chance to become the director of a company. So you can participate in the management. You have a voting right. If before taking a very big decisions of a company in annual general meeting or in any meeting, the company has to take the shareholders' opinion. The shareholders can give their opinion by their voting rights. So the shareholders are getting some power in participating in the management. Next, it is a best investment. The person who want to take a high risk and want to make more profit, it is a best investment. Next is more return. In equity shares, if a company earns more profit, the profit is divided equally to the shares that you hold. So you are getting more return. Next, right to control the affairs of the company. As I explained, you will have a right to control the affairs of the company because you are the real owner of the company. Now let us know the advantages of equity shares from the company point of view. From the company point of view, if the company has to pay the dividend or share the profits only when the company earns the profit. There is no fixed burden of paying the dividend. So the fixed rate of dividend is not to be paid to the equity shareholders. Whatever the profit you have earned, what the company has earned, it is distributed equally to the shares held by them, to the extent of shares held by the equity shareholders. Next, the risk is shared. If I have started a business, but the owner of the company, the investors are public, but whatever I have invested to the amount which I have invested, only to the extent the risk is shared. So here the risk is diluted. So one person is not taking the whole risk. It is the whole investors, whole equity shares are taking the risk. Third point, it is simple and cheap source, as the company has to pay only when it earns profit. So it is a simple, if there is no profit then there is no dividend. So it is simple and a easy source. Next is increase in debt capacity. If there are more number of equity shares, then the company can also have a debt capacity to increase the debt capacity. That means the company can go for debentures, can raise the funds by issue of debentures by paying the fixed amount. Next is availability of fixed capital. So equity shareholders, from equity shareholders you can get a fixed capital, and it cannot be redeemed in between. So it can be redeemed only at the time of liquidation or in closing of the company. So you are getting a fixed capital. So this was the advantages of equity shares. Now let us understand the disadvantages of equity shares, that also we can learn from investor point of view and company point of view. From investor point of view, the disadvantages is uncertainty of income, as the dividend is paid only when the company earns the profit. If there is no profit, then there is no dividend. So there is an uncertainty of income. So we can say it is a irregular income. If there is a capital loss, if there is no capital appreciation, then the equity shareholder has to bear the capital loss. It is less attractive to the modest investor. The people who doesn't want to take high risk, for them it is a very less attractive. Next, loss in case of liquidation. Why we say loss in case of liquidation? Because for an equity shareholder, the whatever amount you have invested, that would be paid only after paying to all the paying to preference shareholder and the creditors and debenture. After paying to them, then later on at the last it is paid to equity shareholders. So if company does not have sufficient fund, the the equity shareholder have to get will get a very less amount. The disadvantages from the company is, since the equity shareholder are the real owner, if I have started the company but the investor are owning more share than me, they will take a control on the company. So even if I have started the company, I will lose the control over the company. So there is a centralization of control, and it is difficult to reduce. Once there is a equity, you are raising, if a company raising equity shareholder, you cannot reduce the capital, because equity shareholder would be there till the end of the company as the real owner of the company, so you cannot reduce. And thirdly, there is a speculation. Equity shareholder always speculate if there is a prices in raise of prices of the share or low of price, they always speculate. So this is one of the disadvantages of equity shares. So kinds of share capital, we are done with equity shares. Next, let us understand about preference shares. Preference shares has to fulfill two conditions. Preference, the word preference itself says they have a preference. They have preference shareholders enjoy some priority or preference in case of getting dividend. The payment of dividend is paid first to equity preference shares, then equity shares. So they are getting preference in getting the dividend. Second point, a preference shareholder are getting repayment of capital In case of liquidation of a capital, in case of closing of a company or winding up of a company, they are paid first. The repayment of capital is done to them first, then equity shareholders. So preference shares are having a preferential rights over dividend as well as in case of getting capital. What are the advantages? Let us know the advantages of preference shares. We can know the advantages of preference share in the point of view of investors and in company. In point of view of investors, the priority in repayment of capital. So they are getting priority than equity shareholders in repayment of capital, in getting the capital. It is better security because the company has to pay a fixed dividend and there is a regular and fixed dividend, fixed income, as irrespective of the profit they are getting a fixed dividend. Next, it is less risky for a modest investor. It is a best option to go for preference shares. And safety of interest. So there is a safety of interest. Disadvantages of an investor is, in case of equity shareholder, if a company earns more profit, the equity shareholder will get more dividend. But in case of preference share, what happens? Irrespective of earning of the preference shares are getting only the fixed rate of dividend. Next is uncertain position of redeemable preference shares. And there is no good position in case of redeemable preference shares. So the preference shares can be redeemed as per the company's rules and regulation. It can be redeemed whenever the company would redeem them. Next is limited voting rights. The preference share does not have a voting right in the company. Advantages of preference share from the company's point of view is, preference share are not the real owner of the company. They will not interfere in the management. So that is one of the advantages of the company. Next, it is economic financing. They have to be paid a fixed dividend. So the company need not share a huge profit with them. Next, availability of wide capital market, and there is no charge on the asset. So preference share does not have any charge on the asset. They cannot claim on asset of a company as they are not the real owner. They will be getting only the fixed rate of dividend. The disadvantages of preference shareholder from the company point of view is fixed economic burden. See, in case of equity shareholder, if a company is not making a profit, then it is not necessary to pay a dividend to them. But in case of preference shareholder, in some type of preference shareholder, the backup of or arrears of arrears in arrears of profit also has to be paid, and it becomes a fixed economic burden for a company to pay a dividend to preference shareholder. Next point, it is a high cost of capital because you have to pay a fixed dividend. Next, it is difficult to raise additional capital because for a preference share the company has to pay a fixed dividend. I thank everyone for watching this video. These are my references. Thank you for watching the video. If you want further information, you can refer these books. I thank you.